Welcome to the MUFG Global Markets podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, May 2nd, 2023. Welcome back to the podcast, George.
Great to be back.
Yeah, good to have you. And it's been a while. So we have, we always have plenty to talk to, but we definitely have plenty to talk to today. So setting the stage here, the U.S. economy continues to send mixed signals, but the trend, I'd argue, is still definitely on the softer side for the high frequency data releases. Even the jobs data, which was a bright spot, that seems to finally be starting to suggest that the slowdown, particularly in the manufacturing side, as well as white collar layoff announcements, are taking their toll on the labor market. Meanwhile, inflation, although certainly elevated, it's clearly on a downward trend. Even if that path to 2% year over year inflation is not a straight line. You and I have been out visiting a ton of clients, supported by your updated deck, including, outlook and various scenarios that you've laid out, the Fed's reaction function, some regime summaries, a lot of good stuff in there. Why don't we start the episode by bringing our listeners up to speed?
Yeah, absolutely. And so we're at this critical point where I think now it's really the moment, the Q2 data into Q3, and this kind of next 2 quarters of really ascertaining if we are in an economic slowdown that's verging or potentially already in a recession. I think now it's really when we're going to get evidence of that, and so I think it's important to see if these trends continue. We are recording this before the release of the April NFP's report, as well as the critical CPI report the following week. And but even beforehand, we've seen some mixed signals coming out from the GDP report, although many have been pointing to the fact that underlying consumer spending has been strong. It goes up, against some of the retail sales data that we've been getting. There's also the idea of nominally things look better, but actual units of sales are actually going down. And then if you actually look really even closer, a lot of the activity was auto sector related during the quarter. And on top of that, most of it front loaded in the January-February period, which saw better weather that really helped the numbers on economic data. Since the mid-February, early March, especially after the start of the bank turmoil that we're in, overall activity has been slowing down in the U.S. economy, which we can get to in a moment on the banking side. But you have that going on the growth. Inflation is heading lower. It's going to be, we have always said, and others have echoed the same, it's never going to be a straight line. It's going to be bouncing down towards hopefully the Fed's target at some point later in the year and into next year. But even then, there's going to be moments where we might see temporary deviations from that downward trajectory in inflation, and that could create further mixed signals. But nonetheless, everything that we've been looking at, all of our high frequency models, all the data, even the way that the jobs market is changing, suggests that we're probably at the precipice or within a recession environment pretty soon. And so we've taken up our odds to as high as we'd probably ever take them to in a 1 year window of a 75% chance that we're in a recession soon, if not in one already. The real question for us is trying to understand how deep and long is it? Is it a short-lived recession? Is it an adjustment process? As long as it doesn't become a financial induced type recession, or if that does not add to the pressure to the economy, then it should be a mild, typical garden variety recession, something along the lines of the 2001 period, which was one of the most mild recessions, even though financial markets adjusted significantly from high levels. In terms of the economic impact, was actually pretty much on the lighter side. The 1990s recession, similar situation. It was a recession, but not like the worst ones like we saw during the 80s or the 2008 recession. So, a mild recession is something that people never want to yearn for recessions, but if we get one, that's probably the best alternative. And then looking through it, is trying to understand, like, are we going to have stagflation on the other side of it, or remain in stagflation and never really get a proper recession, but still have economic weakness? Those are the unknowns, but I'm assigning lower probabilities to those outcomes because the Fed has done a lot of tightening. And in addition to that, we've seen the banking system now also help along those lines with the curtailment of credit and the just banks likely becoming more and more risk averse as we get further bank failures. We've had now 3 so far this year. Not to predict that there's more to come, but the point being is that 3 bank failures, as well as some of the lingering issues that are impacting all banks, which is the high level of rates, the concerns about this morphing from a rate story to a credit story, which is something we've been talking about for many quarters now. And then, of course, just what's happening in the commercial real estate market. All these things are out there, and so the banks probably are going to be a little bit more cautious from here on out, and that will probably restrict the credit availability to the economy, and therefore, probably ensure that we get into a recession if we weren't going into one already. So I think those are the latest updates. It will. I think all of these things should factor into the Fed decision that's upcoming, but we'll see how they react to the latest economic data, as well as these banking stories, and if that indeed changes the Fed's posture going forward. But let's tackle that in the next segment.
And you're doing my segues for me. I appreciate it. So as a reminder for our listeners, we are recording this podcast the day before not the May FOMC meeting, but the announcement from the May FOMC meeting, as they are 2-day meetings. As you just mentioned, the markets are still grappling with concerns about the banking system. In many ways, it's really a pretty similar setup to the March FOMC meeting. As I recall, you had Credit Suisse, the forced, kind of takeover of Credit Suisse by UBS, in the days, just before the meeting. So George, what should we expect from the Fed at this meeting? It's not a meeting where we get the summary of economic projections. So we have the statement, press conference. I'd be curious what specifically you're expecting from both. And back to these banking jitters. I guess I'm curious how you see this third bank failure this year influence the Fed in at this meeting and also in the near term. To put some numbers on it, looks like the market's currently pricing in 22 basis points of a hike for this meeting. So it certainly seems a near certainty. But I'd be curious your take.
Yeah, let's kind of further flesh out the setup going into the Fed meeting and what the Fed has at hand. So, we've been in a blackout period, and during that blackout period, there was another bank failure, and I'm sure that's going to be a topic that's being discussed. So another bank failure. We've also got an update from Secretary Treasury Janet Yellen around the debt ceiling and how that's been pulled forward, where the U.S. may run out of cash much sooner, as early as June 1st. So you would imagine all of this, as well as kind of the mixed signals on the economy, should be playing a role in the Fed's decision making at this next meeting. I mean, I've been on the record for the last 2 meetings, both in written form as well as publicly, that I don't think the Fed should be hiking now. That they should, observe the long and variable lags of all the large, massive hikes they did last year into the early part of this year, and then assess the situation. But nonetheless, what we saw last time, even after the first 2 bank failures, the Fed still went ahead and hiked 25 basis points. It was priced in by the markets, and they delivered. I would anticipate a similar situation this time around as well. As you said in the open, like 22 basis points, or roughly 80% 84% in being priced in. I mean, my rule of thumb is anywhere over 2/3 to 3/4 of a hike being priced in, the Fed probably delivers it. So unless something materially changes overnight, I just don't see them not delivering it. Doesn't mean it's the right course of action, but they'll hike if it's priced in. I think what they'll really focus on, besides that this might end up being the last hike of this very aggressive cycle, I think they're going to really try to craft the language in a way to convey that they're not looking to turn around and start cutting rates as quickly as markets have priced in. So I think that that it's going to be hike happens. This probably will be the last one in our view, and then it's really about getting across this idea that they're higher for longer, which they've been signaling for some time now. But if this truly does become the last hike, then they're going to have to defend that position. And when you're in the hiking mode, it's much easier to kind of maintain the hikes meeting after meeting. Even if they slowed down the pace, they were still pushing rates upwards. Once you go on hold and then you're really just not doing anything and you're defending your position of why you're on hold, that actually becomes harder, in my opinion, to defend, especially when rates are at high levels. When rates are at zero, it's a little bit easier to say why you're being accommodative. But when you're tightening as much as they've done and then maintaining that position, that's going to be the challenge that they face over the coming months and quarter. And we'll see how they set off that. I mean, for now, I think they probably will lean on the whole data dependent, that nothing is pre-committed. And I don't think they want to take the option out of hiking in June per se either, but that could be what is conveyed, and that would be very dovish. But even if they just go to the old data dependent, which means they can stay on hold or hike or cut, I think that would probably be like the way that they want to start to frame the way they handle it, their so-called reaction function to the upcoming news and data. And then we have the press conference, and I'll be curious to see, Chair Powell has mentioned a number of times that the traditional yield curves are something that, although they're important to watch, the curve that they look at is this short-term money market forward curve, and that as long as that's not deeply inverted, we don't think there's a policy mistake being made. Well, if you refresh this 18-month forward 3-month rate minus the 3-month rate, which is the Powell curve, as some people call it, that curve is the most inverted it's ever been in recent history, going back a few decades. And so we have a really deeply inverted curve. The market's signaling the Fed that they probably don't need to hike, or that they should start to think about easing at some point soon. And it'll be interesting to see how he thinks about the curve. The balance sheet also, I think it's going to be important to think about, like see if anyone asks any questions about the balance sheet. And then, of course, given that there's been this third major bank failure, we would expect a lot of questions around, what's the Fed's outlook for the banking system and how they're thinking about just general liquidity. I think that, we'll get a lot, even though we're not going to get the economic projection updates like we did in March, and we'll get the new ones in June. I think we'll still learn a lot through the press conference around how they're viewing the credit tightening through the banking channel and how that relates to their policy thinking. And just in general, just kind of a post-mortem assessment of where the banks are, especially now that we've had three failures in a row. So I think we're going to learn a lot. I think that the body language will be important to see how the conviction about being on hold. I think that's going to be important, and what is said around why they're being on hold. And I think the Fed also gets the senior loan officer survey data prepared for this meeting. So any sort of mentions around the banks R&D tightening more, if they do have that data before, which they should, it'll get published soon enough. Then that'll be an interesting read as well. So we're going to get a lot, I think, bank updates that maybe they're done and maybe they don't want to pre-commit that they're done, staying flexible for the next meeting, and acknowledging that we're probably at a point where policy is restrictive enough to actually bring inflation back down.
Yeah, there's a ton there. I'm sure almost struggling to summarize it. But plenty of things to look at, despite the fact we aren't getting the summary of economic expectations. For our listeners, stay tuned for George's upcoming May edition of his Macro to Markets Monthly. He's going to lay out his views post FOMC and provide a number of those charts that he referenced on the episode today. And again, if you are not receiving George's strategy reports, please do get in contact with George directly. Great stuff as always. Thanks for coming on the podcast.
Thanks, John.
And thank you for listening to the MUFG Global Markets podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.